All right. Well, thank you very much, Marty. Greatly appreciate that. And as Marty alluded to, we have a great panel here today, and they are collecting up front right now. I could see Josette, I can see Ali, and there's John. He's just walked into the picture. So, and we have Tim Smith already up here on screen, just so you have some background on who each of these people are, and they'll do introductions in a minute or two. Tim Smith is the president and CIO of Petrolucrum, which is a single family office investing in all the asset classes, but as he puts it, anchored in energy and technology. Josette Ferrer, she is with Clairent Advisors, which focuses on doing valuations, business valuations. So we're going to have some great discussions about what businesses are worth and how you determine that in markets like this. Ali Evans, the Chief Executive Officer of Metamora, which is an independent sponsor. He splintered off a larger manager and is now doing his own deals. And we're going to have John Taylor, Managing Partner of Stanton Park Capital, which is an investment banking firm. So looking forward to this conversation. We have some real seasoned vets. My name is Mark Heil. I've been involved in the alternatives business since about the mid-90s. Seen it from marketing, capital raising, fund administration services, and helping investors tap into the retirement funds to make investments into alternatives. So I've seen it from a few different angles, and I'm looking forward to this discussion. For the next hour or so, we're going to be talking about private equity and mergers and acquisitions for the remainder of 2023 and into 2024 and a little beyond that as well. Talking about such things as the current market, what's going on now, the cost of capital, valuations, due diligence, deal structures. So we're planning to have some fun here. We invite the audience to join in and ask any questions that they might have as we're going along. But our only request is that you be concise. Get to the point. Time is valuable, and we have great panelists who love to answer your questions. So with that, Tim, I'm going to start with you since you're also on the broadcast here. So why don't you take a few minutes and just introduce yourself and tell us about Petrolucrum.
Sounds good, Mark. Thank you very much. Again, Marty, thank you for having me joining virtually. I thoroughly enjoyed your events. I was thinking about it the other day, I think going back 7 or 8 years. So glad to be back here talking about some of the things that we love to do in private equity. As he had put it, we're a single family office, Houston, Texas based, 4 generations, and original wealth creation in agriculture and energy. Today, we do continue to deploy capital into those sectors, as well as a number of others, as well as different asset classes. We are also going through kind of generational shift right now in terms of some of the concentration we have, moving more into alternative investments, non-correlated strategies, and generational passive income, and then continuing to do a lot of direct investing in real assets and operating businesses. So we typically do lean towards industrials, energy, technology applications, and as I'll talk a little bit about, our preferred strategy for co-investment is a tech-enabled private equity acquisition platform. So we'll talk a little bit about how we're using some of those and also some examples that we've seen recently. So thank you again for having me.
Sounds terrific. Looking forward to that. Josette, do you want to do ourselves a favor here and introduce yourself? Tell us a little bit about Clairent Venture Advisors.
Yeah, sure. Thanks. So as he had mentioned earlier, I really focus on valuing closely held businesses, intellectual property, and intangible assets. So my focus is really kind of a niche focus. I'm not a banker or a broker, really focused on valuations that get reviewed by, I call it another side. So whether that's the auditors or the SEC, for our public clients, the IRS, an adverse party in a litigation, so I often serve as an expert witness. That's really my focus. And it's interesting, I have an interesting perspective. So even though I'm not involved necessarily in negotiating the deals, we do get access to deal models for a lot of our public acquirers and other acquirers. So really being able to kind of open the covers and look at what people are thinking about in terms of deal, synergies and modeling and those sorts of things. So that's me.
So if you disagree with one of your clients' models, how do you go about having that conversation with them?
Yeah, it's an interesting question, and it depends on the purpose of the valuation. So a lot of the valuations that we do are in the financial reporting world, and there are lots of things that we have to do in terms of supporting the forecast that we include in our models. So we start with the models from the client. But often, you have the hockey stick, right? So either we temper those forecasts, or we've really got to reflect the risk as we assess it by looking at, competitors, other companies, and we can reflect that in a higher discount rate. So we have to we can't just take the numbers and run them through. It really is for us, and it's the fun part for me, really understanding the story behind the numbers and what drives the value and what really comprises and makes up the value, not only quantitatively, running the numbers, but really the qualitative part too, which is the fun part. I've been doing it over 30 years, and it continues to be fun and interesting. And I think the fun part is really looking at early stage companies and things that, maybe we saw 20 years ago that are, out there and out in the market now. I think this may date me, but probably I think it was maybe over 20 years ago, we started looking at, the grocery scanning technology, and that was early stage. That really dates me, right? And now it's everywhere. So things like that. I didn't mean to date myself.
At least you didn't say faxing.
That's true. I'm not that old.
Hey, Josette, I'm going to recommend you just move a little bit closer to Ali, if you would.
Oh, sure.
That'd be
Okay.
great. That way you'll be more in the
Okay.
picture. It's better than half of you being in the picture. So greatly appreciate that.
Is that good?
Ali,
Okay.
I'm looking forward to your discussion, and particularly what led you to leave your firm and to go out on your own. So please tell your story.
Sure. Well, it's terrific to meet everyone. I'm Ali Evans. I lead an independent sponsor called Metamora Growth Partners. We focus on buyouts of healthcare technology businesses, both software and tech-enabled services, typically businesses between $5 and $25 million of revenue that are break even to 25% EBITDA margins. And so, Mark, to your question, I've been very blessed on my journey. Started off as an operator at a health insurance company, and then moved on to the investment side, and have been fortunate to invest in many companies that have been a blessing to be a part of their story and sit on boards, and really wanted to take the skills and experiences I had with big companies, kind of $100 to $500 million of annual recurring revenue, and take that skill set and bring it down to the lower middle market, again, sub $25 million of revenue, because I think there's a long runway to create value in those businesses. You can be an owner and watch your capital compound for a very long time at 25 to 40% IRRs, which is much more attractive to me than the upper middle market provides.
Terrific. John, why don't you take a minute out? Tell us tell us a little bit about yourself, Stanton Park Capital, and particularly, what is you look for when you're want to represent a company either on the buy side or the sell side.
Sure. So John Taylor, founder of Stanton Park Capital. So we're a lower middle market investment banking business valuation firm. So we're, most of our experience is consumer industrial products manufacturing. Although we are generalists to some degree, so we've done work in healthcare, technology, media as well. But in terms of what we're looking for, we're mostly sell side focused, right? So for sell side clients, we're looking for businesses with at least $2 million EBITDA plus, right? Because that's kind of a level where we feel a business is marketable to the institutional investors, right? There's been a proliferation in the private equity markets the last couple of decades, right? So there's literally hundreds or perhaps thousands of middle market focused private equity funds. So either from an add-on perspective or platform businesses. So a company with enough scale where it can attract an institutional investor. Financial sponsors certainly very active. Strategic buyers are great, but it can be difficult to get their attention. So that's where we come into play a lot of times.
Sure. And John, you're the last to speak, so you're the first to answer. First question I'm going to direct your way, John. Just give us an overall sense of what's happening in the market right now.
A good question. So I think certainly M&A activity slowed over the last 18 months, right? I mean, if you look a couple of years back, there was a much higher level of activity, and obviously that makes sense. It was a very heated market, going back 18 to 24 months. We're also in a higher cost of capital environment, right? Interest rates have gone up over that same period of time. We've seen some dips in the stock market. Obviously, COVID, and there's been some kind of big impact economic events that have hit the market. But certainly there's still a lot of capital out there for growing businesses, and there's certainly a number of them. I mean, founder, owner, operated businesses, I think, have made up the bulk of the transactions over the last, say, 18 to 24 months. And I think a lot of that's driven by just generational cycles, right? You get baby boomers who are looking to retire. So they're looking to sell, and there's certainly ample liquidity to sell to those folks.
Tim, anything to add on there or anything you'd like to throw in?
He's brought up a very good point. We're in a very interesting position in the cycle in terms of business ownership and generational transfer. Of course, as everyone knows, we're going through the largest wealth transfer in history. And a lot of the next generation, whether it's second or third generation at this point, are not really stepping up to take over those family-run businesses. I would even put it as 1 out of 10 that in terms of friends that I have in the industry. And so these owner operators, these family generational businesses are looking for liquidity strategies, but they also are looking for ways to take care of their reputations and their brand and help them with tax efficient processes. So there's a real unique opportunity for private capital to come into the market really over the next 10, 20 years, but we're in the early innings of it right now, where there's going to be this wide influx of available businesses on the market, off the market, et cetera. But those that are taking advantage of it have the opportunity to pursue those, to pursue industry consolidation opportunities, tech enablement of certain types of companies that haven't maybe reached that echelon, while at the same time providing that kind of liquidity to owner operators. So we find that to be pretty interesting. And then, of course, just the timing of the economic cycles and the weakening of the tech market, overall valuations. I know we're going to get to that conversation. It really is an opportune time for dry powder in this climate. So we're both looking opportunistically at ways to expand our current portfolio, or talking to other family offices about co-investment into their companies, or just actively pursuing buy-side mandates on a co-investment basis. So excited to continue to talk about it.
Great. Well, thank you for that. Ali, you sort of are in an interesting spot. You not only have to buy, you then have to sell. So as you evaluate a business in this environment today, how do you look at it, and how do you make decisions about when to pull the trigger?
And when you say pull the trigger, you mean regarding to buying, correct?
That's correct. Thank you.
Yeah. I think for us, we look for businesses that have asymmetric upside, and we think about that as the base business should be a call option with a bond. And so I'll talk about the bond first. We like businesses that have cash flow. We like businesses where our purchase price is attractive, such that we can have double-digit cash yield without needing to do anything. We don't need to grow the company. We don't need to improve operations. Baseline, we're just buying well, and so we have 10% plus levered free cash flow yield. And then the call option is all the good stuff, and why my investors put me on the board and ask me to do work. It's we get involved and get our hands dirty and try to improve the companies organically through helping with sales and marketing. Having spent my career in healthcare, have a lot of relationships with large health plans, with large health systems, pharma companies, et cetera, where we can make customer introductions. On the M&A side, every single company I've invested in has been acquisitive. We always look to do add-on acquisitions and kind of bolster the product portfolio and expand our breadth within the markets we play in. And then also from a talent perspective, usually these owner-operator businesses, typically they haven't been as aggressive as they could be with acquiring great talent. And so we look out into the marketplace and say, hey, where can we upgrade our management teams? Where can we upgrade the middle management? And that's really where the call option comes in. And that's how you get extraordinary upside outcomes where, you quadruple, quintuple, sometimes even 10x the size of these businesses. And it becomes really exciting for everyone involved.
Josette, everything comes down to a matter of price, right?
Yeah, Mike, can I ask a question to Ali? Is that okay?
Sure.
I wanted to.
You don't have to ask
Just
permission.
thinking-
You can just ask
Yeah,
away.
it's weird that you're up there.
Understood.
So I guess just thinking about the concept of value, Ali, and you're talking about the call option. How much of the upside do you price into what you pay for the company? How do you think about that?
Yeah, look, I mean, as you know, it's your profession. Valuation is more art than science. I think of it as probability weighted and what's the expected value. And so for us, it's some combination of sensitivity analysis. I'm sure everyone in this room has seen those charts that have two variables on them and various different outcomes. What types of returns could you see? And I think it's about, okay, what do you have to believe for a downside case to happen? What does the return look like in a downside case? For us, we usually model that as, we lose the top 2 largest customers and our margins get cut by 500 basis points. We still want to make money in those outcomes. And then to the upside, and so that might be a 10% or 15 or 20% probability case, depending on the end market we're looking at. And the upside case is, okay, what if 2/3 of our value creation initiatives go well? What would that look like? And then that, again, maybe a 10 to 25% type probability weighting. And then our base case is, generally speaking, things go the way they've gone in the past, but maybe one of our value creation initiatives work. And again, that's the balance of the weighting. So somewhere between 50 and 80%
And the
sometimes.
value creation is like quantifying synergies and like the revenue pull through upside, those sorts of things.
Yeah, we usually we're valuing. So in the base case model, we very infrequently value add-on acquisitions, but it's usually organic growth. So, oftentimes, like even before I close an investment, I'll be working on selling for that business because it's a great way to do due diligence. If I can go sell to prospective customer ahead of having the deal close, then, I kind of go in day one with incremental revenue I can bring to the business. So we can underwrite that. We underwrite on the cost side. Usually these companies are, it's not about taking people out always, but it's just, hey, this one person does 100 units of work, but that's because they only work 10 hours a day. We can make that person productive for 30 hours a day and they can do 300 units of work. Oftentimes injecting more technology into their process. And so we can underwrite some of that margin expansion, but we're very conservative. Let's say we think that there's that was a tripling in productivity. You might underwrite 50% improvement.
Gotcha.
So that way, even when things go wrong or they take longer, our models are very conservative. We just closed an investment in May, is now June. We've already hit our plan for the full year.
Gotcha. Okay.
And so all of our investors are very happy because, we effectively are 6 months ahead of plan.
Yeah, exceeding expectations,
That's
right?
by design. We always want to be ahead of plan on every investment we make.
Gotcha. Thanks. Sorry, Mike, didn't mean to.
No, it's all right.
Derail.
Even in that case that he just put up there in terms of price, right? He's got to come. So he's looking at a company. He obviously values it one number. The owner values it another. They need somebody to come in and sort of be the arbitrator, at least give them a number to talk around. And that's where you fill in, come into this. And usually you're probably hired by a banker or maybe by the seller. I'm not sure, but why don't you talk a little bit about that process and how you come to the numbers and how that fits in?
Yeah, it's interesting. So a lot of our valuations, like I said before, really get reviewed and kicked around by another side. So we really have to think about creating a defensible story. And that really comes down to both the qualitative and the quantitative that I was talking about earlier. So really for us, the fun part too is understanding the qualitative. So being able to talk to founders, folks who've been in whatever businesses for years and just understanding that. And from that comes out of that really drives the models that we look at. So at the end of the day, you have kind of the traditional models looking at an income approach where you look at projections, market multiples related to things in the market, public traded companies, as well as transactions. And it really is kind of reconciling all that stuff to build a qualitative story and the numbers that work. And they all kind of move together. And to kind of think about what Ali was saying, when you think about building models, are there opportunities for synergies? Are there scenarios where you can quantify that and explain that? And if you're a seller, can you include some of those synergies in your deal model to say, hey, if I combine with you, strategic buyer, there's synergies for both of us. Is it fair that maybe I get 50% of my synergies built into the value that you pay me? Or is there some sort of an earn out? So I think, Mike, it really comes down to the story that you tell and what comes out of the models. It's kind of an interesting triangulation process, and it really is a lot more an art than a science. You look at the valuation reports and it looks, I call it quantitatively deceptive, and you start to unpack the numbers. Well, how did you determine growth? How did you determine your long-term margin? That's all very subjective, and it has to be, for our purposes, on the stand in litigation, how do you support that? And we have, lots of other support to say comps and similar companies. And it really is developing a story, Mike, at the end of the day.
Are you seeing more compression as a result of, the downturn and as a result of higher interest rates and the values?
No, I think that comes down to when you start looking at the different approaches that I was talking about. The multiples definitely have come down. It's interesting because you have to put the multiples in perspective, kind of in a long-term period. And when I say long-term, you kind of look at the start of COVID. So COVID started, we had a nice run up in the market, probably up until the end of 2021, kind of November 2021. And then interest rates started to rise, and you had a downturn, and probably the trough in June of 2022, kind of up and down from there. And then we saw another downturn and kind of a bottom at the beginning of this year around 2023, January of this year. And then it's been inching up. It's been interesting where we've seen a little bit of, of a recovery, but you still look at comparisons to prior years and, the peak at the beginning of the pandemic, and we're still down. So I think multiples are down because of the increase in the interest rate that really impacts your discount rates for your discounted cash flow analyses, and it brings those numbers down. And you're looking at transactions also where the multiples are lower than prior years. So all three approaches are triangulating to lower values, I'd say, for most industries. But I think, in line with what Tracy was saying earlier, there are industries that you're still seeing very, very top multiples being paid. So cybersecurity, as an example, we were talking about an example on our planning call. One of our clients just closed a Series B implied value of 15 times forward revenue, and the trailing multiple wasn't even meaningful because they don't have a meaningful level of revenue. So I think it depends. It goes back to the story, Tim, at the end of the day. Certain industries are popping. Other areas, it really depends.
Yeah, well, thank you for that. A quick question, just to follow up that, leverage has been coming down on all these companies, clearly. So how much of the depression in price or compression in price is due to the leverage, and how much is just due to revenue generation being discounted?
It's an interesting question. I think it still comes down to speaking about overall risk, at the end of the day, and you look at the business model, and maybe irregardless of the way the company is capitalized, how do you view that risk in the context of the believability and if the plans for the business can come through at the end of the day?
I want to flip over. Somebody asking a question. I'm sorry.
Yeah, I was actually going to follow up if I could on
Please, Tim.
talking points, and this might be a question for Ali as well. With some of the compression of valuations, obviously the bid and the ask spread is widening. I think sellers potentially are starting to get more realistic, but at the same time, right? So I did hear you mention earnouts or other components in some of your valuation discussions. But just curious what else you guys are seeing out there. Is that a good way to bridge that gap using kind of earn in, earn out type of mechanisms? And do you use that as kind of a risk management tool as well with the owner operator?
Well, I'd love to hear John's perspective as someone advising his clients. On our side, so our perspective is that we want to pay a fair price where the business owner feels well aligned with us. If the business owner is going to exit, 30 days after close, then an earnout is not a good tool because they're not going to have an effect on the outcome. On the flip side, if the business owner is going to be our partner, is going to roll over meaningful equity, and it's going to help on the value creation journey, then an earnout can be a great tool. In the first example where they're exiting quickly, we might be more likely to use something like a forgivable note where, the consideration is guaranteed so long as, there's a significant level of customer retention or a baseline level of EBITDA is maintained. So something like that where it mitigates our downside risk, but the seller still feels like they're getting a full price to be paid. So we just try to, as much as possible, align incentives. I think in the healthcare software world and healthcare tech-enabled services, headline valuations, at least at the prices that we are willing to transact, haven't really changed. There's still a lot of competition in the market. It's more so how many bidders are at the table that have changed. When there used to be transactions where it's us versus 10, it's now us versus 4, which is definitely advantageous for us. But at the end of the day, we very rarely are almost never going to be the highest price, especially definitely not the highest cash at close. And so when we win deals, it's almost always because the seller believes in the vision. The seller gets to know myself and my partners, and wants to be a part of the journey with us.
Yeah, I would echo a lot of what Ali said with earnouts and seller notes. I think that it's a great way to bridge a valuation gap. And I think in the current market, you're seeing more of that where sellers still want to sell for a high multiple. Buyers are, maybe a little more skeptical about, paying high prices these days and want to, more comfortable paying lower multiples, especially given the financing issues, right? Less availability of financing and the additional cost of financing. So yeah, definitely. I mean, we had a client recently that had very strong, many years of above industry average growth, and they continue to believe in the business and they're willing to roll over meaningful equity. And so, we had proposed a fairly significant earnout, which would get the shareholders, a really big bite of the apple if the company performs in the future. So, yeah, I think earnouts are a great way to do that, and we've seen both buyers and sellers win from that. So it's a good tool. Seller notes as well that are typically subordinated to any kind of senior debt the company has, but subordinated, that's another way that happens.
Are you
Yeah, it's
seeing
interesting.
other deal structures that people are using other than just the earnout to facilitate a trade? I'm sorry, Josette, you can ask your question in a second.
Oh,
I want to follow up here.
No worries. I just wanted to add, it's interesting. We have an interesting perspective on earnouts. So as part of what we do for financial reporting, we actually have to put a value on earnouts as part of reporting the purchase price. So we've seen so many different flavors of earnouts. And I think just as you think about it, there are some things to do with earnouts and things not to do with earnouts. I think we've seen some that have been written so convoluted that you say, by the time you measure it, what are you measuring, right, at the end of the day? So I think if you were thinking about an earnout, really keeping it simple and kind of what you were saying, keeping it aligned. If the founders are staying there, is it something that they really feel like they're invested in, and is there visibility into what's being measured, right? So if it's revenue or EBITDA, do they trust you guys to be able to measure it appropriately? Or is it some convoluted, if you hit this and you hit this and you hit this, it's too complicated to measure? Then that's where the confusion, and we've seen disputes happen around that where people just don't agree on what the number is, and that results in lawsuits. So I think just thinking through, if you guys are going to do an earnout, really thinking through the dynamics and making sure that there are good things to do and there are bad things to do at the end of the day. Sorry, Mike, didn't mean to step on you.
No,
Yeah, we
it's all right.
typically
Corollary
recommend
to what you just said there. I'm sorry. Just really filling quickly, then John, you could speak. There was a biotech company that sold out to a big pharma company. And of course, big pharma, about 10 minutes after it acquired it, decided it was no longer strategic. Therefore, it took everybody out of that business. And they never earned the earnouts because it was no longer strategic to the big pharma. So you got to be able to protect against that as well. John, I'm sorry for stepping on you. Please step in.
We've seen situations like that as well, but certainly to mitigate some of that risk around the earnout in a disputes, we recommend using a metric further up the income statement. So something like a gross profit metric is usually a better way, because you get down to the adjusted EBITDA line, like Josette mentioned, you could have disputes. In fact, we had a client that had an earnout target, which they missed by, it was less than $50,000. And the private equity sponsor didn't want to pay the earnout, but they had paid things like recruiting expenses to hire new people, which were clearly, kind of non-recurring type expenses. And so, we recommended that they contact an auditing firm and have them send a letter and saying, hey, we dispute this. I mean, they ended up getting a favorable settlement, but yeah, reducing the complexity, I think, and questions in people's minds, a good way to go.
Lots of acquirer discretion on expenses that are appropriate, right?
Exactly.
Yeah.
So we got a question from the audience, and actually it was an area I was planning on touching on a little bit later, and it deals with AI. And I'll give you the specific question they ask, and then I'll put a little color around it. So Gudrun Zoller asked, what do you think the valuation of OpenAI should be versus the 29 billion that is touted? Same question for Anthropic, which is valued at 5 billion with virtually no revenue. So I'm going to just state that these are two very specific things. I would rather speak in generalities than the specific issue here on these two specific firms. But one of the things I was going to throw in, and it sort of gets to the heart of the question of something we debated on a panel Marty and I had yesterday. We had one person who I thought I saw chime in here. It was Tyson Halsey. And he was taking a view that there's a lot of irrational exuberance taking place right now on AI. And then we had another person who was more of the venture capital person, private markets person, who's saying, it's essential, particularly to some types of businesses, to have AI as a component of it. So let's go into a little bit of a discussion about AI, address the question that Gunder had for us, and we'll take it from there.
Want me to take that, Mike? I have some thoughts.
I'm sure. Well, please.
Well, it's hard to talk about those specific companies, but I think as I think about AI in general, I kind of view it as being similar to the .com, craziness in the early 2000s. Again, dating myself, Mike, right? Where you kind of look at things and you say, if people are willing to pay that much more for a company. So other examples, that have happened recently, you look at Runway, which, raised, I think it was a Series D round, $100 million. Google led it, and the implied value is 1.5 billion. And Cohere also had a big round. I think the implied value there was 2.5 billion. So I think the perspective of not everybody can be the next Amazon, right? At the end of the day, and the bets of people that are investing in these companies at such high valuations kind of make the assumption that they're investing in the next Amazon, but that may not be the case. Those investments may turn into like Webvan, right? If you can, I'm dating myself again. So if that doesn't happen, then I think about it in terms of kind of those are big bets, but there are also investments in AI that maybe are not getting as much press. So I think specific applications where maybe the values are more moderated. I don't know what the values are for these sorts of companies, but you think about Deloitte, there was a Deloitte, McKinsey, and Accenture all made very, very focused investments in AI. So I think that there are opportunities in focused areas, but then you also have kind of the rolling the dice and the big values there. So I think it's interesting because I think those big values are one part of the market. You always hear about those, but there may be other opportunities as you start thinking about specific applications in AI, like those consulting companies were doing.
Tim,
I would say that.
Oh, go on, John.
Yeah, I was going to say, I think if you look at a lot of these, emerging technology businesses, whether it was Google a couple decades ago or Apple with, the mobile phone, getting into mobile phones, Bitcoin, right? I mean, these are some of the fastest growing, largest value creation investment opportunities the last couple of decades. So I think a lot of it's driven by the growth of the network, right? So I think with OpenAI, you saw the growth, the number of people signing up to use OpenAI. And I think it set some records in terms of how quickly it grew. That would certainly suggest a very high valuation for the business.
Timothy, you want to follow?
Yeah, I can add to it, and good to hear from you. Good run again. We've had some AI conversations in the past, so I smile about that. Listen, I think several things right now when it comes to valuations. Obviously, AI is the tech darling right now. It's where all the attention is going, and frankly is positioned to be one of the most disruptive technology components across industry over the next 6, 12, 18 months. And so there is, I think, a lot of reason behind that. Those specific examples, frankly, I think it's implied valuation because the partners are right. There's a big value add component to that, and which gives them obviously capability and execution. But I think AI in general right now, with the companies that have truly transformative processes or capabilities, where they do have niche focuses, where they have something that they're accomplishing specifically for a business or an industry or something to that effect, I think are getting really strong valuation components. We're not going to be smart enough to go after those types of multi-billion-dollar valuations. So we're looking specifically at direct application stuff that applies to our businesses or could apply to businesses that we might be targeting. So there's a lot of ways to play the AI investment thesis without having to necessarily take those types of risks. But I feel like that's why they're getting those types of valuations. Both, there's not a lot of other good companies out there that are pushing this tech like AI is right now. And at the same time, strategic partners, Google and these types of players involved, there's going to be a long takeoff period.
Hey, Mark, I have a quick comment on all this, which
Sure,
is,
please.
Bob Bozeman, who was a early partner in SV Angel, once said that the value of all technology goes to zero, right? So there's massive fluctuations in valuation, and OpenAI might have this fantastic valuation today, but if nothing happens the next year, it'll probably be down a lot, right? So, and the untold story basically of all the great tech platforms that are out there is that they are massive acquisitions machines, right? Each one of them has acquired more than 250 companies. So it's not just about your technology, it's about your ability to really strategically pick the right companies to acquire. And that's where guys who are private equity experts and know all about mergers and acquisitions come in, and they can say, well, this is a strategic acquisition, right? So I think those are two things you have to consider.
And Marty, I think
I
the
thi-
other thing too, I mean, to caution, like a lot of companies are just putting AI on everything, right? We were talking about this on our planning call that really understanding if there is value add there, and just because it has AI doesn't mean that there's value there at the end of the day. Because it's hot, right? People are going to put it on everything.
In 2
Right.
years, it'll be.
I think is there somebody speaking in the room?
No, go ahead, Mark.
Okay, I was just curious. I thought maybe you were all listening to somebody else in the room, so I couldn't tell. No, I think it does create a bit of an opportunity because the woman yesterday was speaking in favor of AI. Was speaking about fintech, medtech, and edtech, and she was basically saying if you're in those businesses and you don't have AI, you better go out and acquire it quickly. Because you probably don't have time to develop it internally and catch up to everybody. So I'm wondering if this is opening up some opportunities in the mergers and acquisition space, or at least have you seen that? Tim, I don't know if you've seen it, or John, if you've seen it.
You know, I saw there was an interesting company out of Japan that's very focused. They built an AI tool specifically for mergers and acquisitions. So, yeah, I think it's certainly out there. And I think probably more of that being developed. I mean, there have been some software, tech-enabled platforms that assist with mergers and acquisitions, finding. So those things are out there. And as they maybe integrate more AI and people, believe in the technology and think it can be useful in their businesses, that we'll see more adoption of it.
Tim, did you want to add on, or do you want to?
Specifically within M&A, there's definitely a lot of really exciting software. And I mean, look, everything is a data game these days, right? The general statistic that we've heard is there's more data created in the last 3 years than there has in all of time before that, right? So M&A, mergers and acquisitions, or finance in general is no different. Obviously, there's a lot of fintechs out there that are providing a lot of actionable information and intelligence. There's a lot of systems now automating the due diligence and the file processes, and of course, all the other digitalization or cloud type benefits from that perspective. So to whoever made that comment earlier, I think, whatever business you're in, if you're not looking at how to use AI at this point, you're going to be left behind. So.
Well, it's one of the interesting things that I read on AI was that 61% of private equity firms claim to be using AI to automate due diligence and also deal flow. I'm wondering if any of you are using that for your internals, or if that's something you're not into yet, or have you seen it from private equity firms?
I can comment a little bit on this. So to the specific question around due diligence and deal flow, so in sourcing, I think on due diligence, using tools like ChatGPT from OpenAI and others, call me old school, but I have found that it does not add efficiency to the process, and so we haven't used it a lot. We do use it for helping us with market research. A good example is, we do surveys of target customers in the markets when we're doing diligence. In old life, I would write the survey from scratch, blank Word document. Now I'll go to ChatGPT and say, hey, write me a survey of to send to customers of remote patient monitoring companies. And then ChatGPT will write me a script, and then, I'll spend 20 minutes editing it, but it's a great start to that process versus me starting from a blank Word document. So that's on the due diligence side. I think in sourcing is where it's hugely helpful. There's several software tools that we use to find companies, and a lot of those software tools, they call it AI. I don't know how much of it's AI versus just a matching algorithm, but you can feed in parameters, you can feed in characteristics of companies, and then they scrape websites and feed you back companies that match those parameters. And so that's very useful for us when, we want to find those companies that, maybe they're not at conferences, maybe they're not, actively marketing, because a lot of owner operator businesses don't actively market. They think of it as a badge of honor that they don't spend any money on advertising and marketing. And so, being able to find those businesses through, a software tool that scrapes, for example, government filings, or that scrapes, patent applications, those are great tools for us to identify companies that we may want to invest in.
A quick question here on my side. So are there more opportunities with private companies because of the banking pullback? And I'll give you an example. I got a call from a guy a month ago, 2 months ago. He says, hey, and I've been lucky to meet phenomenal entrepreneurs. So this guy, he's from South Asia, immigrated to America, started a company. He says, revenue is $200 million a year. All right. And JP Morgan's pulling back on their $40 million line of credit. Can you help me find somebody to either do that or put in equity, one or the other? I'm like, wow, this is a fantastic company. Anybody would want to get involved in this. I mean, so are you seeing those kind of situations pop up more frequently now because of the banking pullback?
I could start. I'd say yes, more companies reach out to us who are looking for capital because they can't get lines of credit as easily, and or they're less aware of the private debt markets. And so they used to go to the bank and get a loan. The bank's no longer available, and they're not as plugged into places where they can get private debt. For us, it's not really actionable because we only invest in cash flow positive companies. So, I'm passing those opportunities over to my private debt colleagues, but it has been good for their business.
It was cash flow positive. It was just that JP Morgan was pulling back on lines of credit from like 40 million to 20 million. That's been happening kind of uniformly around the United States. Pulling back on lines of credit.
Yeah, for us, the cash flow positive businesses, we haven't seen a pickup in demand. For those businesses, the primary driver of selling is it's the same: retirement, family tragedy, divorce, or just lack of capability. Business owner, as an operator, feels like they're working too hard and they need help.
I guess my comment is that we've just gone through the longest and greatest period of cheap money in the history of modern man. And so people are coming out of it saying, what do I do now? And a lot of them have used it to avoid selling any equity. This guy had 100% equity in his company, he bootstrapped it, and they're the largest player in their space out of Texas. But anyway.
Yeah, I would say a lot of our clients are owner operator entrepreneurs, which some of them, approaching retirement age, so they tend to be more conservative. They're, kind of raised and maybe like more of an anti-debt kind of mindset. So yeah, they're not necessarily looking, they're either just looking to sell at some point at the appropriate time.
I have a question, if I can take one from the audience. About 20 years ago, one of my colleagues and myself looked at about 20 family-owned businesses to buy. And we're really good at due diligence. Probably experts. So just to give a quick example, one guy made these really fantastic fish tanks. And I think the waterfront restaurant has one of them. So I'm going around and I'm looking at the stuff, and the guy says, well, there's $500,000 of inventory here. And I says, well, I know lumber. I says, you probably have no more than 100,000 of lumber. I says, who's doing the inventory? He says, well, my ne'er-do-well brother. It turns out he never relieved the inventory. So instead of making all this profit, it turns out that the guy's now in a loss. Now talk about a valuation compression, right? But I think that I found one guy one of the officers had quit. There was litigation at the last minute. And it seems like that what do you do in those cases? You just have to walk away, right? But there's a lot of those. And it seems like to me, you can't do them over the internet. You've got to see people in person. And you must have stories like that too, in terms of, looking at it. In the end, we had 20 valuations. We said, hell with it, we're not gonna do anything. But you have some stories like that, and that's gonna be a tough one, especially at these relatively pretty hokey family-owned businesses.
You can go ahead, John.
Yeah, for sure. We've seen inventory compression. The wife's doing the bookkeeper, and she's kind of a QuickBooks novice, and they're missing out on a bunch of inventory value. Cost of goods sold misstated, and the profits of the company go from 5 million to negative, right? So we've seen a lot of situations like that for sure. But certainly I think with the software, the AI tools, I think you can think of that as more kind of usage in top of the funnel where people are, sourcing for opportunities like Ali mentioned. But when you're getting into the diligence and, you have the attorneys involved, I mean, a lot of that's still very manual driven. I mean, I'd like to see people, private equity firms and buyers close deals more quickly. We just haven't seen that yet.
Yeah, we had
Absolutely.
a gentleman who was on one of these panels before, Peter Plout, and he says we have to get back to old-fashioned due diligence, actually calling and talking to people on the phone, running through the numbers ourselves, making sure we understand everything about the business. And he said in this current market with the slowdown and the longer time for deals it's taking, that was something he was returning to. And I wondered if that was something you're seeing as well, John.
Yeah, certainly. The due diligence processes. I mean, it still takes as much time as it ever has. I mean, I started in this business 20 years ago. I don't see deals closing faster at this point than before, even though, certainly companies are using more software, but all that means it just gives them more ability to do more diligence than they're able to do before. So, what I've learned is that, even, early days when banks and a lot of these institutions started using software to leverage productivity, like all it does is, people are still working the same number of hours. Again, it's just, they're just going to do that much more analysis and do extra diligence because they have the ability to do it now. So, we don't see things, we don't see the diligence process speeding up due to software and a lot of these great tools that have been developed in recent years.
Mark, we only have a few minutes left. Do you want
Okay.
to head towards
Well, what
closing?
I want to do, if I can, I want to jump over to Tim. And, another area that's sort of been accused of irrational exuberance has been the clean tech space, with a lot of money going in there. We all remember 2008, where a ton of money was poured into biofuels and things of that nature that never materialized. Bessemer recently started talking about, these companies need to be more sensitive to market timing and be more nimble. And the State of Climate report stated there's still gaps in the industry around infrastructure and adoption. So Tim, you have a particular energy background, and I don't know how much it's clean tech versus the old oil and gas, but maybe you want to enlighten us with some thoughts here.
Yeah, I'd be happy to give you guys some talking points, and then I'll have to unfortunately depart to get to a board meeting that I kind of double booked. But on that subject, so we're an all energy equation group. We love energy transition. We like clean tech, but we do still have a significant exposure to oil and gas, both ancillary businesses and behind the drill bit. A lot of opportunity in this market with weaker oil prices to take advantage of that. So we don't distort that fact. But on the other side of it, there's a lot of really exciting things happening in clean tech and newer technology developments in renewable, hydrogen, carbon capture, and electric vehicle infrastructure, and a number of things like that. So, we don't profess to be, a pioneer on any of these types of things, but we will look at business opportunities to either utilize technology or find ways where it may be applicable into the marketplace. So, I think as you articulated, without a doubt, there's been an enormous amount of money poured into this space, particularly under this administration, which has been very much welcome. So anybody who's in that space has been able to obtain pretty much very attractive valuations and access to capital. A lot of government grants and things have been coming down in that space. Still a lot of technology challenges though, right? So we like renewables, but the same pitch for solar 20 years ago is the pitch today, right? It's not really changing a whole lot without subsidies. Clean tech or other things, I think that there's a huge opportunity, and there's a lot of investment opportunities in the EV space, for example, but the practicalities of being able to power a significant portion of the actual domestic fleet or nationally is far from realistic, because they have to put an enormous amount of money into just developing the energy, electrical infrastructure, which we're far behind on. And at the same time, available rare earth minerals, lithium, cobalt, things like that. While maybe not a huge issue today, try to add another 5-10% of the global fleet, and they will be, right? So we like where it's headed, but it's a challenge. It's a challenge still, right? And the people are putting out really ambitious goals and moving away from fossil fuels in California and other places, which they're asking EV car owners to not charge in certain periods because they're worried of blackouts, right? So it's heading there, but there's growth challenges, right? So we love to hear and look at any of those types of ideas, but we obviously look at it with a unique lens and for practical purposes.
Yeah, actually, there's a big issue in Latin America with renewable energy, which is that if you go to like Panama, Costa Rica, et cetera, there's like wind farms in different places, but apparently there's a heavy cost of maintenance for all these wind farms, and it's very difficult for them to be able to acquire parts because it's so expensive. So it's very intriguing. Anyway, Mark, can we wrap it up?
Yeah, I think we can. I'd like to thank all our panelists. I think we had a great discussion here this afternoon. So